According to European media reports, Austrian Chancellor Karl Nehammer announced his intention to resign after coalition talks to form a government failed. Canadian Prime Minister Justin Trudeau is also on the verge of stepping down. Meanwhile, in France, according to a poll published on January 3, 61% of voters want Emmanuel Macron to resign. Given the no-confidence vote passed against Germany's chancellor in the mid-December, the risks of a government crisis in several leading global economies have taken on a system nature. This clearly does not add confidence to market forecasts. The US economy, in contrast, appears healthier. However, the markets are currently far more concerned about the United States. The closer Donald Trump's inauguration gets, the greater the uncertainty grows regarding how much reality after January 20 will align with his campaign rhetoric. The potential risks of the US president's policies fuel demand for the dollar as a safe haven asset. Its index held close to its highest level in the last 2 years, around 109 points today. At the same time, the more hawkish outlook for the Fed Reserve promises to keep the dollar in a leading position moving forward. However, it's causing damage to most of its trading partners. Last week, for example, 30% of the most popular currency pairs and crosses lost more than 1% in value. A similar wave of volatility is likely to hit the markets this week, potentially creating new trading opportunities to start the new year. Meanwhile, risk of sentiment has grown so strong that even the traditional Santa Claus rally in the United States stock market was cancelled. As a result, there are hardly any bold traders willing to get against the powerful US dollar. This will inevitably affect the euro as the main dollar counterpart. The bearish sentiment on the euro is driven not only by government crises in Germany, France, and Austria. As long as Donald Trump's tax incentives accelerate the economy and drive up prices in the United States, the tariffs he imposed will slow down the Eurozone's GDP and flood Europe with cheap Chinese goods. This could create a deflationary threat for Europe, bringing the region to the brink of a recession. In turn, parity between the euro and the dollar could be just around the corner. Incidentally, analysts from 3 major banks, Investec, Wells Fargo, and Rabobank, expect this parity as early as the second quarter of this year. The euro has already tested 2-year lows around 1.02, kicking off the new year in a clear long-term bearish trend. However, in anticipation of key data and uncertainty in the United States, the euro-dollar pair may enter a consolidation phase. Experts recommend using rebounds from the 1.0335 and 1.0365 resistance levels as selling opportunities. On the other hand, if the euro climbs above the December 30 high at 1.0458, bulls will have a chance to push towards the strategically important resistance level of 1.0550. A breakout above this point would pave the way to the next obstacle at the technical level of 1.0663. Importantly, trends in the euro-dollar pair often involve significant pullbacks. Therefore, traders may find it beneficial to consider short positions, especially in the light of incoming economic data. This was evident today following the release of improved PMIs in Germany and the Eurozone as a whole. Besides, a report on inflation in Germany is published today. The annual CPI is expected to rise from 2.2% to 2.5%. This means that the euro will receive another boost to regain its footing against the US dollar. However, the triumph of the European currency risks being short-lived. Its rise could be cut short quickly right after the release of the US business activity report. Preliminary reports predict the composite index will grow to 56.6 points in December. If the actual figures come out to be lower than expected, the euro may respond with the consolidation or even growth. Meanwhile, oil is re-upping these benefits of another series of China's promises. This time, China's President Xi Jinping plans to introduce additional measures to stimulate the domestic economy. These promises set the stage for a rally in the oil market last week, with the Brent crude jumping by 3.7%. However, everyone understands that Beijing is unlikely to take any drastic steps before Donald Trump takes office. As a result, oil prices opened lower today, but the oil market is not driven by China alone. As you can see, Brent's chart still showed signs of growth, albeit within a narrow range of $76.10 to $76.90 per barrel. Bullish catalysts are the cold temperatures that have settled over the northern hemisphere, as well as the prospects of a production cuts not only in the United States, where the number of active oil rigs has dropped to 482. Additionally, according to Goldman Sachs experts, sanctions under the new Trump administration could reduce oil supplies from Iran by the second quarter. As for the Russian currency, experts set targets in the range of 109 and 111 rubles per dollar until mid-January. The dollar-ruble pair is currently going through a correction following a sharp decline before the New Year holidays. The ruble itself appears to be strongly oversold. Thus, the scenario of a strengthening towards the 100-ruble level cannot be ruled out. Besides, the Russian currency is receiving some support from rising oil prices. However, given that public holidays in Russia will last until January 8, robust market movements during this period are unlikely. So that's all for today. We monitor developments in financial markets, subscribe to our channel, and stay up to date with the latest news with us. See you online soon.